Forex Candlestick Signals Lesson 2, Doji Candlestick in Forex. A doji candlestick has the same opening and closing price, so its real body appears as a horizontal line. It represents indecision in the market. Let's take a look at what's going on when a doji forms. As the session started, the price was driven up by buyers, but it could also have been sellers driving the price down. Then, sellers pushed the price back to its opening price and even lower, just to meet the buyer jumping in the market again and drive the price up to its opening once more. This process could have been repeated several times up to the end of the session, when the price closed the same as it opened. As you can see, there is no real conviction about which direction the price should go, and that's what makes the candlestick neutral. I wouldn't advise anyone to make a trade based on only the appearance of a doji. However, if we see a doji after a strong bullish move and we're at the resistance level, it could indicate that bulls have become exhausted and bears are ready to take control. Or the opposite. In a downtrend, after a strong selling pressure, a doji appearance at support could indicate that the bulls are getting ready to go along. The most important thing to remember when trading candlestick signals is to look at the context. A doji in the middle of a trading range means absolutely nothing, and you should never trade it. A doji at support or resistance, however, is a completely different story. Now let's get into the interesting part. A doji has appeared at resistance. Remember, doji is a neutral signal, so don't jump in the market right away. Instead, let the market come to you. Wait for a close below the doji's low and only then open your short positions. When placing your stops, you have to ask yourself one question. What is the price that tells me I was wrong? In this case, a candle closing above the doji's high would invalidate the reversal signal. So I would place my stop a couple of pips above the doji's high. A dragonfly doji is formed when the session's opening and closing prices are at or near the session high. It's a bullish reversal signal, so we only look for that in a downtrend. Bears were in the charge at the start of the session. They pushed the price lower, but then bulls rejected this lower level and were able to drive the price up to its opening, where it also closed. A gravestone doji is the exact opposite of a dragonfly doji. It's a bearish reversal pattern, and we will only look for it in an uptrend. Bears were in control. They pushed the price up, but this new high was rejected by bears, who managed to push the price back down to its opening price. The long-legged doji is a candle that had the same opening and closing price, but has very long shadows on both sides. This candle signal shows complete indecision between the bulls and the bears, and it's not advisable to trade on its own. I know I've already mentioned it, but this is extremely important. Candlestick signals are valuable only when looked at in context. A doji in the middle of the range is a no-go. A doji at support or resistance, however, is something to be looked at.